123 high on Brent a week or so ago. Um, as the survey question just posted there from yesterday, has the oil markets met its kryptonite with the Fed move at 75 basis points and announcements of more such bold moves. And this rather bullish market audience in this room at least says, no way, baby, we're back to the races. So let's kick off this morning with no way, baby. Omar Najia, global head of derivatives at BB Energy. Omar, markets obviously took a little bit of a pause last week. What are your thoughts this Monday morning? Where are we going?
Well, first of all, I don't think it's got anything to do with the Fed, but I do think that price action was like I don't think anybody wants to play now, so I think it's people just want to take stuff off the board because we're coming into summer. It's quite a difficult market now because it really could go either way. So I anticipate that I think highs are not going to come now for maybe we're going to have to wait until September. So I think
what do you mean by highs as such?
So the market, I mean, when a market moves like it did on Friday, it means that people aren't interested in the upside anymore, at least not immediately, right? So that kind of puke out, that kind of sentiment, it's like going out on a night out and people are drunk, and I was a complete puke out. So what you do the next day is you don't go and buy some more whiskey or gin or vodka. You kind of leave that aside for a month and you kind of, say, I'm never going to do it again, never going to do it again, never going to do it again. Come September, you go out and you buy yourself a little bottle. So that's what I mean by it's too early for the highs again. So I think we pause, whether sideways or whether lower. I think we pause until after the summer. That's the message that I'm getting from the market on Friday.
Okay. Let's go to Australia. Clyde Russell, Asia Commodities and Energy columnist at Thomson Reuters. Clyde, looking at the products end of this bull market, of course, that's where all of the big bucks are. Crude is just for paupers, really. China is somehow, for whatever multiple reasons, keeping its refinery powder dry. They're somewhat 30% or operating at about 70% capacity, leaving that's a number of millions of barrels of possible oil products. We saw numbers out of Asia this morning, gasoline year on year on May, absolutely crashing it and so forth. Why are China not taking advantage of this huge moment?
Sure, if I could answer that question, I'd probably be, making a lot more money than I currently do. It's a hard one. Every logical thing says, yes, China should be taking advantage of the massive spreads on producing diesel and gasoline and exporting like crazy. But they're not, especially since they seem to be getting fairly good access to cheap Russian crude. There is always a question mark as to whether people will actually buy refined products made with Russian crude or the threat of being made with Russian crude. But leaving that aside, there does seem to be an enormous opportunity for them. And it's curious as to why they haven't. I must admit, I would have expected them to have done so or to start issuing a lot more quotas, because quite frankly, it's an easy economic win for them. It's a way to quickly ramp up exports. It's a way to quickly increase economic activity. It's a very easy stimulus measure to do, but they're not doing it. I mean, yes, there was a little tranche of more export quotas for the refiners at the beginning of this month, but still not enough to make a meaningful difference. I mean, if you look at diesel, their exports in May were something like 20,000 barrels a day, 29,000 barrels a day. That's down from over levels of 400,000 to 500,000 a day last year. That's an enormous amount of diesel to lose out of the Asian market, and explains partially why we've got the diesel profit margin, the crack, being above $50 a barrel in Singapore. So to my mind, I can't explain it. I don't think it's in China's interests to not supply these barrels. I think it runs a risk of increasing the risk of a recession in much of the developed world, and certainly in the developing world. I would think, and that's definitely not.
Is that the point? Is that the point here? I mean, keep the squeeze on Biden.
Well, that would be a political win, but it would be a massive economic loss for China, given how how much their economy depends on exporting stuff to the West. So if you're going to really crash the Western economy and the developing world economy along with it, in order to make a political point, well, that's a brave decision, especially when you're fighting a COVID battle at home and your domestic economy is pretty much, not looking so strong. So to me, none of this makes sense, to be quite honest. I expect that sooner or later the Chinese will decide to ramp up their fuel exports. But the key point is you've got to look at the numbers, and the numbers are saying they're not doing it yet.
Let's welcome Jamie Ingram, Senior Editor of Middle East Economic Survey, sitting in London to make sense of all things Europe. Jamie, every Monday morning we wake up and Europe seems to be in even more stress around its whole energy security challenge and the geopolitics of it. I mean, overnight we've seen Macron lose his majority in parliament. We've got the Germans firing up coal and other, and of course, this is the first Monday morning in a way we're waking up with this new reality around natural gas, and it is now in the mix of this economic war. What does it look like for Europe?
Yeah, good morning, Sean. Thanks for having me. Let's be honest, the European kind of electricity situation is a complete mess at the moment. We've just emerged from COP26, everybody talking about phasing out hydrocarbons. Now we've got Germany saying, yeah, we're going to be firing up coal plants now because, we've been too reliant on Russian gas. That needs to end now. What about nuclear in Germany? That's a question that everybody wants to know about. Clearly Germany is moving towards LNG. They are optimistic that they're going to have floating import capacity starting up by the end of this year, which, everybody I speak to says that this is actually feasible in Germany because they have done a lot of groundwork in the upcoming years when they were kind of umming and ahhing about, is this a direction that we want to move towards? Clearly, though, there's the issue of where do you get the LNG from? Qatar, they're starting to bring in partners for their expansion awards, but that's something that won't start up until 2025, hit full capacity 2027. They're talking about supplying Germany with their US Golden Pass LNG terminal. Again, that doesn't start up until 2024. So Europe's kind of sucking in LNG from other markets. They're basically outbidding emerging markets. It's interesting as well. It's not just on the gas front that we're seeing this. We're starting to see kind of the oil trade flows start to crystallize into new patterns. Iraq been very aggressive in terms of cutting their pricing into Europe, certainly in comparison to what the Saudis and Kuwaitis, for instance, are doing. That seems to be starting to pay dividends. We're starting to see more Iraqi crude kind of be sucked into the European basin as well.
Omar, just coming back to the point of pause till September, there was an old saying in stocks, I think it was like sell in May and come back in October or something to that effect. Is the turbulence now and the structural end of this market? We're seeing the whole market having to restructure on all financial assets around the price of money, which is now making notable leaps upward. And in order to really assess the real value of things, we've really got a sense of where is the price of money going to sit.
Well, the price of money, inflation in Europe is double digits. Inflation in the States is double digits. So the Fed hiking rates 75 basis points is just nothing.
But they do it 5 times.
Yeah, but if they do it 5 times, you know what happens? What happens to equities? They go down the toilet. So it'd be like. So this is the problem, right?
Do you have to make a choice here? Do you think between obviously the inflation and the stock market, or?
No, it's not a choice. It's a massive trap, right? So they're damned if they do and they're damned if they don't. If they do nothing, inflation skyrockets. So they pretend like we're going to bust 75 basis points. But inflation's 10%. What difference does it make? Nothing. What's the other alternative? The other alternative is you raise rates massively, 5, 6, 7%. And that brings inflation under control. But then your debt is the biggest it's ever been. Consumer debt in the West, government debt in the West, corporate debt in the West. So everything just goes, right? Because to service your debt, you're going to have to pay so much money that it all implodes. Meanwhile, you've got the euro, the GBP, the yen, all tanking. And the dollar basically is the only currency that people will hold in the West because there's demand for it worldwide. So no, it doesn't look. I mean, it doesn't look like a great situation. So I think basically inflation is here to stay. I don't think they're going to raise rates, and I think they're going to, we're going to have prices, inflation, and all that kind of stuff for a long, long time to come.
And strikes in London. Jamie will be working from home whether he likes it or not.
You got
Omar,
it, Sean.
Omar, just on that point. The price of money. We were already earlier in the year hearing the poor old traders are only making billions at the moment, moaning about the credit line stress. I'm just wondering, as we move into a world, imagine a world in which you actually have to pay interest on money, what impact do you think that is having, could have on the whole trading universe in terms of its access to serve credit lines?
So it's much worse than that, because nobody wants to invest in anything to do with hydrocarbons, anything, anywhere. And by that, I mean the West, right? Because everybody's green and tree hugging and all that kind of stuff. The second thing is banks, they don't want to lend people money so trade finance, buying physical cargoes, lending companies money to trade and all that kind of stuff. They also don't want to do that, because that's not good. They'd rather lend, if you want to plant a tree or something like that. So it's all gone completely and horribly wrong. I mean, I think it's a disaster. Plus, let's say you borrow from a bank, $1 million, 100 million, whatever it is. If the price of each cargo keeps going up, your credit is fixed, so you can do less and less trading in terms of, because the price is going up and up and up. Plus, you have to basically factor in the cost of money, because the banks aren't lending you, the ones that are lending you aren't lending you for free. So it's all terrible. And so what traders do, I mean, we're not, we kind of, we make things more efficient. We're like cleaner fish. So, we're in the ocean and we make sure that everything's nice and clean and dandy. So when you don't have that, you get more market inefficiencies. So it's it's absolutely amazing. I mean, people just think that, it happened yesterday or since February or since March or since Biden or since Putin. No, it's been going on for like a decade. So, forget about any fixing anytime soon.
Clyde, we've seen again back to China, reports overnight that China as crude oil imports from Russia soaring 55% year on year, but even over May over April, moving from 1.5 million barrels a day to 2 million barrels a day, displacing Saudi Arabia as the biggest exporter into the Chinese market, of course, the world's largest oil importer. How do you see the outlook for that moving in terms of this, obviously cheap oil available?
Well, I think the Chinese will be very tempted to keep buying cheap Russian crude, especially if they allow their independent, refiners, the so-called teapots, to buy Russian crude. But, my own feeling is that what we're actually seeing now, the imports in May and June, was almost a result of what one person in the market called panic selling by the Russians come, in March and April, where they were desperate just to sell as much as they could. And they were offering much steeper discounts than what was reported in the media. People were talking discounts of $30, $40 a barrel to Brent. I heard that there were discounts bigger than that in Asia for Chinese refiners to take some of that Russian crude. So I think you might see a sort of tapering or a slowing in the growth of the amount of crude that China is taking, but they are going to take quite a lot from Russia, and they're going to keep doing that on a sustained basis. The other country that's going to keep doing that is India, as much as they're able to organize the freight and the transportation and insurance of ships and things. That's their challenge. But at the same time, is that going to offset the fact that the Russians probably won't be able to sell much in the way of cargoes to Japan or to South Korea or to the other buyers that they had out in Asia, not to even mention what they were doing in Europe? I think the jury's still out on that one. I mean, I think overall the Russians will struggle to sell as much crude as they were prior to the invasion of Ukraine, but they're probably going to sell a lot more than your sort of more optimistic Western political analysts would be hoping for.
And just, Clyde, on follow up on that, what does that mean for the Saudis and the Gulf Arabs, the OPEC Arabs countries here that are, China's their biggest market. If this continues to move with cheap Russian oil sort of taking up market share in China, how does that coexist in the harmony of OPEC Plus looking for a renewed agreement in September?
Well, I'm not sure I would ever use the word harmony within, to describe OPEC Plus. I think it's an organization of convenience. I also think the thing that always strikes me about looking at Saudi Arabia, and I don't pretend to be an expert on the Saudis in any shape or form, but what they do seem to do is they're only really interested in playing the long game. So they see this as a temporary disruption, and they don't see it as undermining their long-term relations. They know that the Chinese have, over the long term, very little option but to continue to rely heavily on Saudi oil. And the same goes for India. Even if Iran comes back into the market, it's not going to push too much of the Saudis out. So I don't think they're too worried about it. They see plenty of opportunities for them, and they have the ability to cut their prices if they so choose. If they start to have refiners who sort of say, well, we're going to take less in our contracted volumes, if they start dropping off what they're allowed to drop off in terms of their fixed contracts, then I think you'll see the Saudis start to move on pricing. But at the moment, I think they're really thinking that the Russians just can't simply supply enough to make a huge dent in demand for Saudi oil.
Jamie, the other big story over the weekend, which obviously was percolating for a few weeks now, but finally sort of came to the surface of confirmation that Biden and MBS, the ruler of Saudi Arabia, the de facto ruler, Crown Prince of Saudi Arabia, are now going to have this infamous meeting. Your thoughts on that? What does that mean? What's the geopolitical framework around it? Is it just too simple to say, oh, he wants more oil, that's why he's coming to Saudi? That seems to me a little bit of a kind of simple sense of what's happening here. Your thoughts?
Yeah, sure. And it's definitely an interesting one. As you say, Biden's finally acknowledging that he's going to Saudi Arabia. I think oil's clearly going to be one of the leading issues that they're going to be discussing. But let's remember, he's going to Israel first. He's then going to Jeddah, I believe it is, where there's going to be discussions with leaders from across the Arab world, GCC, Iraq, Jordan, also going to be there. Security is going to be one of the big hot issues of the day. They're talking about the Abraham Accords. How far can they move Israeli relations ahead with the Arab world? Clearly, the UAE expanding trade relations there, Bahrain as well. Is Saudi Arabia going to get on board with this? I doubt it at the moment. I think we're going to see more of a covert relationship continuing to develop there. Iran is going to be one of the big issues that they're going to be discussing there. They're moving ahead with their enrichment capabilities. They're getting closer and closer to breakout ability on that front. So then what happens to talks over a nuclear deal if Iran's effectively already capable of producing nuclear weapons? Where do we need a complete reset of those talks if we reach that element there? Clearly, the Saudis, the Emiratis have been very disappointed with the US security projection vis-a-vis Iran in recent months. Tailed off a little bit recently, but certainly at the beginning of the year, there were constant attacks coming across the border from Yemen. I
struggle. I can see what the Saudis obviously get and the region. I think what the MBS ultimately gets, in my opinion, is the final blessing of Washington to ascend to become king. I think that is the real big prize here for him, because up till now they haven't given that. But what does Washington get from this? I struggle to see, other than a few thousand barrels of oil. That seems kind of a nonsense for the scale of a kind of reversal that Biden's making here.
Yeah, but I think the big thing is how much can they spin it? If they can demonstrate that Saudi Arabia is willing to at least play nicely with them, that's something that they can then pivot with on the domestic front. So I think that the actual victory is how you can demonstrate it rather than an actual fundamental impact on supply and demand. Because the Saudis, they can pump another 1 million barrels a day, let's say, from the top of their quota as it will be in August. That's not really going to move the market. And the Saudi Arabians, they also want to make sure that they maintain spare capacity in case something a bit even bigger happens in Libya, for instance, or another volatile hotspot. But I think one of the really interesting things is, again, just looking to see how Biden tried to row back on things last week. He tried to claim that he wasn't going to be having a bilateral meeting with MBS. It was just going to be within discussions elsewhere. I mean, come on, he's trying to pander to his base there by saying he's not going to meet with MBS.
Well, I think he's also managing expectations. It doesn't sound like he's getting anything.
Yeah, but he's just making everybody annoyed with him, because the Saudis think, well, hang on, you're starting to insult us now. But the people who are annoyed that he's meeting MBS at all, they're not going to care about that distinction about whether it's a bilateral or a multilateral. So he just loses everybody.
Interesting. Let's go to the survey question and get everybody a chance to give their thoughts on this China's May gasoline exports fell 45% year on year, despite stalling domestic demand and soaring Asian and global demand for products. What is the biggest reason why? That's a question I gave to Clyde earlier. Why is China not exporting? It's got 30%. It could be the difference in the world today between these record high distillate prices and something that the world could manage in terms of the whole inflation challenge. So I'm wondering what the view in the room is on why China is doing this. China's green agenda, which is not insignificant. They've made a massive commitment to cut carbon, and obviously particularly the independents, the teapots, are typically heavy, old carbon heavy refineries. So keeping them shut in is probably good for that. Squeeze on Biden, we talked about keeping those elevated $5 gasoline prices for Joe as he goes. Plumber Joe takes a drive through Oklahoma this summer. Not going to be happy. 3, China energy security. Of course, they expect their economy to recover. They want to have their own supply available. None of the above. What's the view in the room on this? So Omar, Monday morning, as we said, oil down $10 on the week, sitting stuck, not really moving this morning, looking for direction. As you say, you mentioned earlier that it's hard to say which way it could go. We've seen upward being the only way in recent months. What would be the downward? What would be the momentum to take it down? And what are the structural sort of resistance lines there?
I think basically people not wanting to be long or unwinding length will take it down. I don't think markets work in terms of, somebody says something, then markets goes down, and then somebody says something, then market goes up. So maybe they just want to unwind length. They don't want to play anymore. They want to book profit. Market's getting too volatile, whatever. But so what you saw on Friday was people heading to the exits. And when the trade is so one-sided, so it's like, everybody wants to go through kind of, one exit, the exit's tight. And there's so many people that, it turns into a bloodbath, which is what we saw on Friday. So I think, like my analogy with the drinking thing, I think that's what's going to happen. But the thing that also
everybody's going to AA, I think you said.
Yeah, but people tend to always think about supply. They don't understand that demand in this market is massive. So if I was Russia, I wouldn't be worried about selling anything to anybody. So there was a JP Morgan, I think, note that they sent out. And they said that to address the shortage of oil alone, by 2030, the world would need an additional investment of $400 billion. So forget it. The growth of global energy demand will outpace the growth of energy supply by quote unquote 20%, right? So you can absolutely forget about whether Russia is going to sell extra barrels. Doesn't matter, right? You sell 10 barrels at $1 or you sell one barrel at 10. So the world, I'm afraid, is changing completely. Commodities are changing. The price of stuff is changing. Fiat currency is changing. The banks in the West are changing. The economies in the West are changing. Everything is moving. We're no longer multipolar. You need to, if anybody has time to read what Putin said or what Sanchin said or what Lavrov said, you should take a look because it's going to affect markets in a massive way, I think.
Said when exactly? Because obviously they've been speaking a lot
at the St. Petersburg conference. So he released. They all release all their stuff. It's in English. You can read it. So you can read about what they're saying about energy, what they're saying about U.S. markets, what they're saying about politics, what they're saying about the military, all this kind of stuff. So right now in the West, we're living in a kind of fog, right? Because the West is winning. Everything's going to be okay. We've sanctioned them. They're going to collapse and, economic war. The EU says this has to be won on the battlefield. The US says we will support you till victory, all this kind of stuff. Soon, this fog's going to clear one way or another. And it's either going to go, victory for Russia or victory for the combined West. And it's going to matter massively. So let's wait and see what happens. Every day that goes by is a day that favors a Russian win. The West is financing his war.
Fine. Well, that's interesting. Let's go to Australia and get Clyde's view on. Obviously, Omar's looking at the technicals there. Clyde not giving much credence to interest rates impacting demand, but nonetheless, these are significant rises in the price of money globally, and for a region of the world, i.e. Asia, and particularly emerging Asia, holding a lot of US dollar denominated debt, this is a very big moment.
Yeah, it is a big moment, and I think people are sort of underestimating the sort of effect that this will have on demand, for commodities. I mean, if you actually look at it, a lot of the inflation problem that the world's had is a commodity-driven inflation. There wasn't enough supply, price of commodities went up, and they went up quite dramatically. And then the Russian invasion of Ukraine just poured fuel onto that particular fire. So the only way that you're actually really going to solve this problem is, demand decline and demand destruction. And I think that's probably the point where we're reaching now, especially when you look at a developing world in Asia and Africa and even Latin America. Those countries are going to suffer tremendously. Already, Pakistan can't keep the lights on because it can't afford LNG, because the Europeans are buying everything. The Indians are struggling with coal. I've been at $400 a ton for Australian thermal coal. That's quite frankly a ridiculous price. It's insanely high, let's put it that way. So when those prices start to filter through into the real world, what actually happens is that your demand drops and you end up with a fairly nasty slowdown in the economy, and that kind of solves the problem. I mean, if I actually really wanted to not raise interest rates but still slow the economy, I'd let commodity prices run, because in some ways that will force the economy to slow all by itself.
Well, as the Fed said, or some of its voices over the weekend, and we have one of those stories on our digest today, that they'll do what it takes, but it could take years to bring this inflation rate back to 2%. Jamie, let's give you the last word with the survey result this morning. The keep the squeeze on Biden seemed to just pip China energy security, but nonetheless, that's one possible solution. But I wanted, Jamie, to get your final thoughts of where Europe is at vis-a-vis its appetite. We had a few stories over the weekend. Obviously, we had the three big leaders in Kiev last week showing solidarity. But then we had the German finance minister over the weekend saying that their debt payments next year are going to be massive because of interest rate rises. We saw Macron over the weekend lose his majority in the parliament. So the left has gained, and to an extent the right, Le Pen. So the extremes of essence will really curtail his strength as a president. I'm wondering, where do you think Europe is at in its appetite to hold the line vis-a-vis the face-off with Russia?
I think where Europe is at is it's divided, Sean. I think we're seeing real political divisions within, the UK and Eastern Europe tending to take a more hardline stance on this. Europe and France and Germany tend to be taking a more conciliatory, let's try and cut a deal with Putin, pushing Ukraine down that path. I think that's where we're at the moment.
And that would be, I think it's a summer. I mean, as we face this outcome of economic squeeze, obviously you're going to have strikes in the UK this week, which is quite significant and could be an indicator, as they say, the cuckoo in the coal mine, of more social stress to come from both inflation and austerity that will be with raising rates. We'll have to leave it there this morning. Great to have all these amazing voices: Clyde Russell in Australia, Omar Najia in Dubai, and Jamie Ingram in the UK. Really, really appreciate you kicking off the week with us and your insights. Oil, as we said, Brent at least trading flat this Monday morning in Asia at 113 a barrel after the big collapse on Friday. Will Friday prove to be an inflection point where we revisit the sort of numbers that we saw before the war in Russia, or will we do what we've done in the past and bounce right back again and go knocking on the door of 120? We'll see in the coming days. Thanks, guys. Catch up with you next time. All the best.